All right, let's just get straight into it and completely transform those unpredictable market opens from a trader's worst nightmare into some highly predictable opportunities. Welcome to this explainer, where we are going to take the guesswork completely out of the equation.
You know the feeling. You're trading equities, maybe the US 30, NASDAQ, Bank Nifty, or even commodities like gold. You wake up, look at the screen, and boom, massive gap. It can literally paralyze your decision-making. Suddenly, the price is miles away from yesterday's close. Do you chase it? Do you fade it? Well, that confusion is exactly what we're eliminating today by breaking down the exact mechanics behind these leaps in price.
So, here's our game plan. First, defining gaps and imbalances. Second, the gaps you absolutely must avoid. Third, trading breakaway and runaway gaps. Fourth, reversals and exhaustion gaps. And finally, using gaps as support levels.
Okay, part 1. Defining gaps and imbalances. Look, a true gap isn't just some tiny skip in price. We are talking about actual empty space. If the current candle's open is entirely above the absolute high of the previous candle, that's your gap up. If it's strictly below the previous low, it's a gap down. That empty space means absolutely zero trading happened at those price levels. Now, not all gaps are created equal, right? You're going to see a few specific patterns pop up out there. Common, breakaway, runaway, exhaustion, and island gaps, plus liquidity voids. We're going to attach a very specific rulebook to every single one of these so you never have to guess what you're looking at again. Moving on to part 2, the gaps you must avoid.
This is the classic trap, the common gap. You'll spot this forming when the market is just dragging sideways in a tight range and the trading volume is totally normal. They are usually just knee-jerk reactions to overnight news, totally lacking any real institutional backing.
So, the golden rule here? Do not trade these. Seriously, just sit on your hands. Why? Because the price almost always whipsaws right back to fill that empty space. If you try to chase a common gap up by buying, the price will snap back down and you're going to get stopped out for an immediate loss. Just let this one go.
All right, part 3, trading breakaway and runaway gaps. This is where volume becomes your absolute best friend. If you see a gap aggressively tearing out of a long consolidation range, you must see high volume. That's your breakaway gap. But, and this is a big but, if you are already riding an established trend and a gap forms right in the middle of it, high volume is actually a massive warning sign. For that mid-trend runaway gap, you want normal to low volume. So how do we actually trade the breakaway? First, spot the gap breaking the range. Second, verify that huge volume spike. Third, and this takes discipline, wait. Don't just jump in. Wait for the price to break the high or low of that specific gap candle. Finally, tuck your stop loss safely behind the previous structural level. This setup has an incredible 70% to 80% accuracy, but only if you have the patience to wait for that volume confirmation and the candle break.
Now for the runaway gap, it's a slightly different context. You're spotting this mid-trend. Crucially, verify that the volume is normal. Remember, if the volume is crazy high during a trend gap, it might be turning into an exhaustion gap, which is exactly why we want normal volume here. Once again, wait for the high or low of the gap candle to break and enter in the direction of your trend.
Part 4, reversals and exhaustion gaps. Picture this. The market has been tearing aggressively in one direction for days. The slope is crazy sharp, everybody and their mother is piling in, and suddenly, boom, a massive gap appears with absolutely extreme volume. That's an exhaustion gap. It looks like incredible strength, but it's actually the final gasp of a dying trend. The smart money is bailing out, and you should be getting ready for a reversal.
To actually trade this without getting burned, you need confluence. Spot that extreme volume gap at the end of the trend, then check your stochastic indicator. If your stochastic isn't confirming an overbought or oversold level, scrap the trade entirely. Walk away. If it does confirm, you wait for the price to turn around and fill the gap. That fill, that's your entry trigger for a massive reversal trade.
Then we have the island gap. It looks exactly like it sounds, this lonely little cluster of candles, completely marooned from the rest of the chart by a gap on both sides. These signal immense volatile moves, but patience is key here. You really need to give it 10 to 15 minutes for the price to settle before jumping in, just to make sure it doesn't snap back. The only exception is if your confirmation candle is extremely small, then you can hit the break right away.
Finally, part 5, gaps as support levels.
We've got to distinguish between two flavors of empty space here. A liquidity void is when there are absolutely no overlapping wicks between candles, literally zero trading occurred.
90% of the time, price is just going to aggressively blast through that and continue in the same direction. But a volume imbalance is different. The bodies gap, but the wicks actually overlap, showing a little bit of trading happened. That volume imbalance acts as a strict structural floor or ceiling.
Here is a rule to just permanently burn into your brain. Whenever you see these gaps, especially those volume imbalances, they are not just empty space. They are fortified zones. As long as the price stays above an upward gap, your uptrend is totally safe. That gap is your floor.
So how do we milk this for profit? The retest strategy. Draw a box around that entire gap zone. Then just wait. Wait for the price to eventually pull back and test that zone. When you see the price reject it, literally bouncing off it like a trampoline, you enter. Toss your stop loss safely beyond the nearest swing high or low, aim for a strict 1-to-2 risk-reward ratio, and let the gap's natural support do all the heavy lifting.
But hey, what happens if the floor literally caves in? This is your ultimate risk management tool. If your gap support gets broken by a firm, solid candle closing entirely beneath it, the trend is dead. That's your conditional trigger to immediately flip your bias. That broken support is now your new resistance, and you need to start hunting for trades in the opposite direction.
Now you're probably thinking, does this work on my 5-minute chart or am I stuck swing trading? The beautiful answer is, time frames do not matter. The underlying mechanics of liquidity, volume, and unfilled orders are identical whether you're scalping the 5-minute or holding daily candles. You don't have to overhaul your whole strategy, just layer this gap logic onto whatever time frame you already love. You now have the exact playbook to turn a trader's absolute worst nightmare into your most profitable setup of the entire week. You know when to ignore the common gaps, when to pounce on a high-volume breakaway, and how to use empty space as a structural floor. So, tomorrow morning, when that opening bell rings and the chart starts jumping wildly across your screen, are you going to panic? Or will you calmly check your volume, mark your...
All right, let's just get straight into it and completely transform those unpredictable market opens from a trader's worst nightmare